Welcome to Lunch Money. Coming up, why did the Bank of England hold interest rates today? We'll look at what that means for you, your savings and your mortgage. And stick around if you want to know whether Sainsbury's Nectar Prices trick is helping it in the supermarket battle. Hello, I'm Simon Lambert, and I'm joined today by This Is Money's editor Lee Boyce and Interactive Investors Victoria Scholar. Lee, the Bank of England held interest rates again today at 5.25%. Why has it opted to hold for a second time in a row?
Well, simply put, not much has changed since the stick last month. So economic data is still relatively soft. They don't see the need to push the button, raise rates again. And of course, while they might not say it's directly linked to what the Fed does, the Fed also paused last night, and a lot of what Bank of England does come from the other side of the Atlantic. So they've decided to pause it. Inflation is still 6.7%, the same reading that we had the month before, and it feels like that potentially they feel like this could be where it sort of peaks, but it'd be a fool's game to call that.
That's the big question, isn't it? I mean, how much certainty can we have that this might be the peak? When does a number of pauses turn into a peak?
Well, that is a very big question, isn't it? And you think about the summer, we were talking about 6.5% being the peak of this cycle. So now 5.25%, quite a way off that. A lot of the markets are kind of pricing in now this being the peak, and next year mainly staying around this level. When's the drop-off going to be? That's the next question, I guess, that people are going to be asking themselves. But it feels very much at the moment the markets are seeing this as a pause, and this is where it's going to stick. And things that have been causing inflation to rise, such as petrol prices, actually have softened slightly so far this month. So that might, again, ease a little bit of pressure. But there's so many unknowns. I mean, look at what's going on in the Middle East, for example. Things can change very quickly. And that's why I pointed out that 6.5% in the summer that was getting widely banded around. I mean, how quickly that has changed back again. So it's really hard to predict at the moment, but things do feel like they're softening a bit.
Those inflation numbers should be helped by the drop in energy prices coming through from the energy price cap coming down, and that will come through next month. But the one place where people have been affected by this is their mortgages. What's going to happen to mortgage rates now? What does this mean for mortgage borrowers? Well,
since the base rate's been rising from December 2021 onwards, up the 14 rises that we had until a couple of months ago, people's mortgage bills have obviously been rising quite a lot, unless you were lucky enough to be on a long-term fix before all of this kind of madness started. So the average 2-year fixed mortgage has gone from something like 2.5%, long-term average of the last sort of decade or so, to above 6%. So that's hurt people. And even if you are on a fixed term, come off that fixed term, you're likely to have remortgaged at a higher rate. It's the SVRs, the standard variable rates, where people really feel the pain. So the average standard variable rate was something like 4.5% in December 2021. It's now above 8%. And if you are on an SVR, it's likely that you have seen your lender put up rates quite quickly after the base rate decision is made. And people are seeing £100 extra added onto their mortgage. But this time around, and from the last pause, there has been a little bit of breathing space, and people have got used to what you could dub the new normal, which is just a long-term average of what people have seen in the past. But newer, younger homeowners are not used to this kind of turmoil, and they've been hitting the pocket, especially if you took out a 2-year fix in summer 2021 and you're just coming off that now. The pain will be quite strong.
So this return to the old normal is painful for first-time buyers, it's painful for anybody hoping to move home, it's painful for anybody who needs to remortgage, but it's not been bad news for savers, has it? What's the outlook for savings now that rates have paused again?
Well, a lot of it has been priced in. So we have seen savings rates absolutely rocket in the last 12 months. People have been able to get a 6% fix over a year. And that is, a rate is very high compared to what we have seen in the past decade, 15 years. Really, but the big nub of that is that no savings account beats inflation. Inflation reading at 6.7%, getting 6% in your savings on one hand, but inflation 6.7%, you are still not matching that. But we are seeing now savings rates starting to drop off. 6% 1-year fixes are starting to disappear. Easy access rates seem to have peaked and are kind of at about 5% now. It's unlikely we're going to see much more in terms of savings rates grow. I think we have well and truly hit the peak there.
So savers are going to be hoping for that point where their rate crosses over with inflation coming back down in the other direction, interest rates, I'm not going to ask you to give us an exact date of when you think they're going to fall, but when are interest rates going to start to fall? What's the consensus view?
Well, you'd be a fool to be making predictions on this, as we know. But next year, the talk is that it's going to largely stick around where it is at the moment. And then from 2025, the kind of general view is around 3%. It might fall to around about 3%. But there is so much time between now and 2025 that I just think it's impossible to predict.
Thank you, Lee. Victoria, we care about the Bank of England base rate in this country, don't we, very much?
Yeah.
But it's the Fed that matters, isn't it? The Fed also paused interest rate hikes for the second time last night. Why has it done this?
I think you're right. The Fed does set the stage for global monetary policy, and we saw that the central bank kept rates on hold, but it's at a 22-year high. This comes off the back of an aggressive stream of monetary tightening. I think there are a few factors. Firstly, inflation has been coming down from the peak of last year. It's now at 3.7% in the US, so much closer to the 2% target than we are here in the UK. Also, interest rates work with a lag, so we're still feeling the effect of previous interest rate rises over the summer. And also, we've seen that bond yields have been at multi-year highs, and that's created some tightening of financial conditions and actually helps to do the Fed's work for it.
Have we peaked? Has the US peaked? That's the big question on everybody's minds, isn't it?
Well, I think the Fed wants us to believe that there is the potential for more monetary tightening on the horizon. It wants to show that it's data dependent, but I think the likelihood is probably that we have peaked. There was some signalling in the language from Fed Chair Jay Powell to hint that this could be the end, or at least very, very close to the tightening cycle. I think it's keeping the door ajar for December, but I would expect that we'll probably see another hold at the end of the year.
Stock markets would be cheered by that, wouldn't they?
Yeah, we're coming off the back of a shaky month for markets globally, and we saw a pickup in sentiment after the Fed's pause. Of course, tightening is negative for equities, so this hold caused some positivity for stocks, and also it caused bond yields to pull back a bit as well. So a little bit of a pickup in risk appetite, I'd say.
Now, back at home, we've had results from Sainsbury's today that have cheered investors. What is one of Britain's biggest supermarkets, one that I always think as maybe that sweet spot between people trading down from Waitrose and not going all the way down to Aldi and Lidl? What's it telling us?
Well, it's a really strong set of results. We saw half-year profits come in at £275 million in terms of its pre-tax earnings, and it says it expects full-year profit to come in at the upper end of its guidance. There was some strong sales as well, particularly in groceries that were up by over 10%, whereas its general merchandise was a bit more sluggish with growth of just over 1%. But investors very much cheering the results today. The stock is up quite sharply, and it's extending this gain that we've seen this year. Of course, amid the sort of flight to safety trade, we've seen that consumer staples have been quite in demand because, of course, we have to buy these essential items like food. So that's played well into the hands of the supermarkets.
And Nectar Prices. Mm-hmm. It's a bit controversial, some of this supermarket loyalty stuff, isn't it? Is Nectar Prices helping Sainsbury's out? And what's the idea behind this Nectar Prices scheme?
Yeah, I think you're right. I think that one of the big focuses for the supermarkets has really been to try to get their customers through the doors and create that brand loyalty. So we've seen that a lot of the supermarkets have been cutting the prices on essential items to drive customers into stores, and then hopefully they'll then spend on a lot more products. And it's kind of the same rationale with these loyalty schemes, that if you're accumulating points, you're somehow getting something in return, then that will continue to encourage people to stick with one supermarket, because at the moment we're seeing that shoppers are branching out to lots of different shops, and with the cost of living crisis, of course, consumers are a lot more price sensitive, which has been playing into the hands of the German discounters Aldi and Lidl, while some of the more expensive, more luxurious brands like Waitrose have been struggling a bit more. So it's really this race to the bottom, firstly in terms of prices on essentials, and also a real renewed focus on these loyalty schemes.
And with giving the Nectar Prices only to a Nectar card holder, or the club card prices only to a club card holder, it creates a bit of a virtuous circle for Sainsbury's and Tesco, doesn't it? It means that they can get more people to sign up, try to build that loyalty, but also limit the price cuts and not be offering them to everyone?
Yeah, you're right, and it's a good way for them to pass on some of the cooling inflation pressures to their most loyal customers, because Sainsbury's has been saying today that inflation in food has been coming down, although we've seen from Kantar, the latest figures, that food inflation is still above 12%. So it's on a positive trajectory, it's at a one-year low, but still sharply above the headline rate of inflation. But as those inflationary pressures ease, then we would expect the supermarkets to continue to pass those on to their customers, particularly for those who are those loyalty customers.
Thank you, Victoria. And thank you for watching. That's it for today's Lunch Money. Join us on Tuesday for the next show. Goodbye.